Welcome to a webinar on the new insurance contract standard, IFRS 17. This webinar is part of a series of materials that the International Accounting Standards Board is producing to support the implementation of the new standard. My name is Maria Karamanu and I'm a Technical Associate on the Insurance Project.
My name is Joanna Yeo. I'm a Senior Technical Manager also on the Insurance Project.
Before we start, as usual, the views expressed in this presentation are those of our own, and not those of the International Accounting Standards Board or the IFRS Foundation. A copy of the slides used in this presentation is available for download from the website. Those slides are accompanied by additional material. Let's see where today's webinar fits in the overview of the IFRS 17 requirements. Today's webinar is about the core requirements. It provides high-level information on the essential measurement requirements on IFRS 17. In IFRS 17, there are some modifications that reflect specific economic features of specific contracts to achieve IFRS 17 fundamental objectives. In addition, IFRS 17 has simplified accounting for contracts of short coverage periods in which the measurement outcomes of IFRS 17 are achieved and in a simpler way. We plan to have webinars on these modifications and these simplifications at a later stage. The IFRS Foundation is producing webinars as part of its activities to support the implementation of IFRS 17. We have previously published a few webinars on IFRS 17. This slide highlights how this webinar fits in with the rest of the other webinars on IFRS 17. Moving to what are the core requirements of IFRS 17. Insurance contracts are measured as the sum of two components, the fulfillment cash flows and the contractual service margin. The first component, the fulfillment cash flows, the net future cash flow estimates, are probability weighted. Fulfillment cash flows also reflect financial risk. The probability weighted cash flows are brought into present value terms. Additionally, fulfillment cash flows reflect non-financial risk because a premium for non-financial risk called the risk adjustment is added on top of the present value probability weighted cash flows. The second component, the contractual service margin, represents the unearned profit from providing services promised in the contracts. In the past, this was sometimes referred to as the building block approach.
We will be talking about the essentials of the core measurement requirements of IFRS 17 in two parts. You are now listening to the first part, which is how you initially measure the fulfillment cash flows and the contractual service margin. The second part of the webinar will focus on the subsequent measurement and will also be available on our website.
Let's discuss the measurement of the insurance contract at initial recognition. We will start with the overall principles and estimates used in determining the fulfillment cash flows. Firstly, estimates are entity-specific. However, sometimes an entity will need to use market variable estimates. In that cases, estimates of those market variables must be consistent with any observable market prices. Please note here that the insurer's own credit risk is not included in the measurement of the insurance liability. That is because the insurance liability is not measured at fair value. As discussed on slide 4, the fulfillment cash flows are the first piece of the insurance liability. The present value of the future cash flows is the first component of the fulfillment cash flows. Let's start with the estimates of the future cash flows. Those estimates, as you can see on the slide, include acquisition costs and directly attributable expenses, as well as expected claims. Those estimates also reflect the effect of policyholders' behaviors For example, expected lapses. The time value of options and guarantees is also reflected in their measurement. The measurement would not be complete without another important bit, all the expected premiums over the contract boundary. Joe, what do we mean by the contract boundary?
The contract boundary requirements in IFRS 17 identify which cash flows should be used when measuring insurance contracts. The boundary of the insurance contract distinguishes whether expected premiums and the resulting benefits and claims arise from existing or future insurance contracts. The contract boundary ends for an existing insurance contract when the entity has the practical ability to reassess risk and reset the price or level of benefits for individual contracts. If an entity assesses a contract boundary for a portfolio of contracts instead of an individual contract, it also needs to consider whether the price does not take into account the risks that relate to future periods. So based on the example in this slide, the cash flows within the contract boundary are, firstly, the premiums for the 4 quarters of 2021 and the claims and benefits arising from those premiums which may occur after 2021. The contract boundary is reassessed at each reporting date and therefore may change over time for some contracts. In estimating the cash flows within the contract boundary, the first component includes all the cash inflows and outflows that arise directly from the fulfillment of the contract. The estimates must incorporate all reasonable and supportable information without undue cost of effort about the amount, timing, and uncertainty of possible outcomes. Let's explain what is meant by all reasonable and supportable information. We mean that the expected present value of future cash flows are estimated by developing a range of scenarios that reflect the full range of possible outcomes. After having identified the full range of possible outcomes and the respective scenarios, for each scenario the entity estimates the amount and the timing of the cash flows, applies a discount rate appropriate to those cash flows, and then estimates the probability of that outcome, and therefore applies a weight on that scenario based on the probability of its outcome. Regarding the appropriate discount rate that will bring the cash flows into present value terms, we will discuss it in future slides. Additionally, the estimates should be unbiased. Statistically speaking, an unbiased estimate is the mean of a distribution. Conceptually speaking, unbiased means that no conservatism is included either in the cash flows or in the probability weights. Additionally, if there are any financial options and guarantees in the insurance contracts, they should be reflected in the estimates as mentioned on earlier slide. Financial options and guarantees create nonlinearities, and therefore stochastic modeling techniques may be employed in that case to incorporate these nonlinearities in the estimates of the cash flows. How do you bring the unbiased probability weight estimates into present value terms? This is done by applying a discount rate. The cash flows are discounted using rates that reflect the characteristics of the liability. The rates used are current, market-consistent rates. If the cash flows are not linked to the return on the assets, in other words, if an insurance contract is a non-participating contract, the discount rate used is essentially a risk-free rate, adjusted for the fact that the insurance liabilities are less liquid. The insurance liabilities are illiquid or less liquid because normally someone, the policyholder, needs to make a claim before the policyholder is paid. So, for example, a risk-free rate on a liquid bond would need to be adjusted to get to an illiquid or less liquid risk-free rate. It is worth noting here that a margin for the insurer's own credit risk is not included in the measurement. If the cash flows on the insurance contracts are linked to asset returns, then both the cash flows and the discount rate will reflect that asset risk. How does an entity determine a discount rate under IFRS 17? IFRS 17 permits 2 approaches. Let's start with the bottom-up approach. Let's assume that the cash flows are not linked to the return on the assets. which means we assume that an insurance contract is a non-participating contract. Under the bottom-up approach, we start first with a risk-free rate of a liquid bond, which would then need to be adjusted to get to an illiquid risk-free rate. As explained before, the illiquidity premium adjustment reflects that an insurance liabilities are less liquid than risk-free bonds. The second approach is called the top-down approach. The starting point is different. It uses a different asset rate instead of a risk-free liquid bond. The entity could still meet the objective of the IFRS 17 discount rate so long that the resulting discount rate would reflect the characteristics of the liability, and this is done by appropriately adjusting that asset rate. So an entity will need to make appropriate adjustments for any characteristics that are present in the asset but are not present in the insurance liability. For example, the asset's market risk premium and differences that arise on the amount and timing of the cash flows. After those adjustments have been made to the top-down approach, the entity does not have to adjust for further liquidity differences between the assets and the insurance contracts. In principle, both approaches, the top-down and the bottom-up, should provide the same number. In practice, however, the two approaches might result in different numbers for different reasons. Disclosures are required on the information used to determine the discount rates and the yield curve years. What if there is little or no market data? In that case, the entity will need to use judgment to appropriately adjust observable market inputs to accommodate differences between the cash flows of the observable market instruments and the insurance contract's cash flows. However, sometimes there is no market data. In that case, an entity would need to apply an estimation technique. An entity will need to develop unobservable inputs using the best available information in all circumstances. An entity will also need to adjust those data to reflect all reasonably available information about market participant assumptions. So, in the last few slides, we've discussed the cash flows and the discount rate. By putting it all together, we have the present value future cash flows. And this is estimated by developing a range of scenarios that reflect the full range of possible outcomes. In each scenario, the entity determines the amount and the timing of the cash flows. It then applies an appropriate discount rate to those cash flows and estimates the probability of that outcome and therefore applies a weight based on that probability. We will now move on to the next piece, the risk adjustment.
Thank you, Joe. So the second piece of the liability is the risk adjustment. This is for non-financial risk. The risk adjustment addresses the uncertainty related to the cash flows driven by the non-financial risks present in the insurance contract. For example, the uncertainty related to the timing or the amount of payment of claims, or both the timing and the amount. Let's have an example regarding the risk adjustment. Risk adjustment is a company-specific measure and is basically the return that the company wants to earn in order to take on the non-financial risk. It is the compensation that would make an entity indifferent between fulfilling a liability that has a range of possible outcomes and fulfilling a liability that will generate a fixed cash flows with the same expected present value. For example, Group A is a group of contracts that has a 50% probability of paying a present value of 1 million and 50% of paying nothing in 1 year. Group B is a group of contracts that has 100% probability of paying 500,000. Both Group A and Group B have the same probability weighted average of 500,000. For Group B, therefore, the risk adjustment would be the amount of compensation the entity needs in order to be indifferent between issuing Group A and Group B contracts. After explaining what the risk adjustment is, Joe, could you explain to us how to measure the risk adjustment and what to reflect in its measurement?
As mentioned before, the risk adjustment is an entity-specific measure that reflects the entity's own risk aversion, as well as the entity's view of its diversification benefits in issuing a group of insurance contracts. IFRS 17 does not specify the technique or method that an entity must use to estimate the risk adjustment. The technique or method must, however, meet the objective for the risk adjustment. Disclosures are required on how the entity determines the risk adjustment and the confidence level of the risk adjustment, even if the entity used a different technique. We have now covered Piece 1 and Piece 2, and what remains now is the contractual service margin. The contractual service margin is the amount determined so that there's no gains recognized in profit and loss on initial recognition. It is, in essence, the unearned profit of a group of contracts that relates to the provision of future services. Maria, could you please walk us through a simple example on initial measurement of the contractual service margin?
Thanks, Joe. Let's consider a group of contracts for which the risk adjustment is 750 and the present value of future cash outflows is 4,250. Under the first scenario, premiums are 5,500. The CSM, as Joe mentioned, is the amount that would not result in a gain in day one. In this example, the CSM is 500. This is the amount determined after deducting the cash outflows and the risk adjustment from the premiums. Under the second scenario, the premiums are now 3,500. In this case, the cash outflows and the risk adjustment are greater than the premiums. As explained before, CSM is the amount that would not result in a gain in day one. In this case, there is a loss on day one of 150, and so no CSM is recognized. That loss is recognized in profit or loss immediately.
The earlier slide considered a simple example, and this slide goes into further details. To determine the contractual service margin at inception, the entity first estimates the fulfillment cash flows as discussed before. The entity would then need to de-recognize any insurance acquisition cash flows that occurred during the pre-coverage period and will recognize as assets or liabilities. I'll talk a little bit more about that in the next slide. The entity will also need to take into account any actual cash flows on the day. As explained before, the contractual service margin is then the amount that eliminates a gain at inception. Let's discuss how the insurance acquisition cash flows affect the measurement of a group of insurance contracts. Insurance acquisition cash flows are cash flows arising from the cost of selling, underwriting, and starting a group of insurance contracts that are directly attributable to the portfolio of insurance contracts to which the group belongs. When the insurance acquisition cash flows occur before a group of insurance contracts is recognized, that is, it is in the pre-coverage period, the entity will need to recognize those cash flows as a liability or an asset. On the date the group of the insurance contracts is recognized, the entity de-recognizes the liability or the asset for the insurance acquisition cash flows as discussed in an earlier slide.
That's the end of today's webinar on the initial measurement of the insurance contracts. We are closing with a snapshot of IFRS 17 core requirements. We hope you found it useful. As stated before, we intend to produce future webinars and other materials to support the implementation of IFRS 17. More specifically, as stated earlier, please listen to Part 2, where we will cover subsequent measurement of the fulfillment cash flows and of the contractual service margin. Thank you for listening to today's webinar.
Thank you and goodbye.